Matt Doran of Sage Wealth Planning is one of my favorite business partners and somebody I always enjoy speaking with. In this video, we take a look back at 2020 and how LMDG has been impacted, as well as the entire investing landscape of COVID-19 and the lessons we have learned. Hi, it's Aaron Merriman with LMDG. We're a real estate investment company and we focus on multifamily apartment buildings in great locations in Southern California. If you're new, be sure to subscribe to our channel and check out our other videos. So joining me today is Matt Doran with Sage Wealth Planning.
Thanks for having me back, Aaron. It does seem like it was a very long time ago, but it was only 8 or 9 months ago when we did this the last time. And, you know, I think the things we mentioned then still ring true today. And that is when there's some major disruption or exogenous event, it often compels people or makes people think they should abandon their long-term plans, do something dramatically different, move to the sidelines. And the guidance we were giving them then was, you know, that's generally not the best thing to do. And while we've had a wild ride and could not have predicted the many things that have transpired in the last many months, staying the course was the best thing to do. And it's playing itself out now in many ways. But I think for those who stayed with their plan, they've been rewarded.
If you just think about our investment strategy, right? We're very focused. We really don't deviate, and that has proven out. I mean, we've done extremely well. You know, when you're investing in multifamily real estate, rent collection is everything.
Right.
And the reality is there's blood in the streets across basically every sector of real estate. Because of interest rates, residential has done okay, but multifamily all the way up to obviously shopping malls are in serious distress. We've done incredibly well. We've been virtually unaffected on the rent collection side of things. We had one tenant that was out of property that was about a half a month behind. Recently, we were able to negotiate a buyout there, and it's just been a win-win for everybody. We'll renovate that unit and bring it back to market and double the rent, basically take it from $2,000 to $4,000 a month. But the fact is, and when you look at the landscape, I read a recent article, 1.6 billion of uncollected rent in just the state of California is the projection for the end of the year. By the end of the year. And so there's all these kinds of stats. I mean, unemployment in California was under 4% a year ago. Now it's, 10 to 12%, depending on where you look and, the time. But we have held true and we've done great on some sales that we've done. So, I know, and you and I have obviously talked, all the time, but just the way people think about investing and, and there's a term that you use that I thought was awesome, but so I'd love you to talk about it, but just sticking, picking a proven methodology of investing, something that's risk averse and just sticking to it through the ups and downs, is really what makes a difference in the long term.
Yeah, absolutely. And your numbers are astonishing. I think it's testament to the approach that you have and the commitment that you have to maintaining that focus on where you bring the most value. So, on our side, it's similar. I think when you get into a market like this, there's a big temptation to shift your style to whatever's performing the best. And from where I sit, it's not either or. It's a well-diversified portfolio always has growth and value, right? Stocks and bonds, large company and mid and small. Domestic and foreign. And that's because we know that the economy is cyclical. And while we don't predict exogenous events like the one we're experiencing now, we do know that different things respond in different ways to changing economic conditions. And so rather than having to pivot or guess or, take big risks or make big bets, we allocate for change that we know is inevitable.
That's a great point. And what we're kind of seeing on our market, and I'd love to get your thoughts on this, just more on the security side of things, but there is that flight to quality right now that we're feeling. When you look at properties that we've sold recently, in our second fund, which is, into the third year now, we were able to do 4 distributions in 2020, and they were all done in the second half of the year once we felt good about rent collection. And we've certainly been affected by COVID. Anybody that says they aren't, just is delusional, right? On an investing front. But we feel really good about the distributions that we've done, the size of those distributions, but also the properties that we've sold, because we sold 2 properties out of Fund 2, in one in Q3, one in Q4. And, the property that we sold in Q4 was at a 4.25% cap rate at almost $700 a square foot. And that's a phenomenal cap rate anywhere, but even in coastal Southern California, which this property was, coastal Long Beach, just, ocean view almost. It's a great price. There was certainly no COVID discount. We wouldn't have sold it if the price wasn't right. And I believe that is the kind of flight to quality that people that are looking to park money into stable assets. And we're seeing that. Obviously currently we're raising capital for Fund 3. We've got 4 properties in there already, but we are seeing an uptick on that because what we do inherently is lower risk, low leverage, 50 to 60% LTV across the board all the time. And then, interest rates are super, super low right now. Everything we're doing is below 3.5%. So that's great. And, it's worked out. So, but it's very much, having the fortitude to, have an investment strategy that you believe in. We've certainly battle tested the heck out of that strategy during this pandemic. And so that's giving us even more wherewithal to say, yes, this is absolutely the right way to go, and to continue to do that going forward and not deviate.
Well, in the interest of full disclosure, I am an investor in Fund 3, and people should know that. And one of the reasons I am is because I believe in the strategy, and I believe in the management and the commitment to that strategy. And it's not as if we don't expect to encounter problems or change. It's how well we respond to those changes and whether we need to do anything different or not that matters, right? And you and Aaron have really stuck to a strategy that's well thought out and well executed. And I think that investing is just part of modern life. And unfortunately, not everybody's in it because it's entertaining and exciting. It's just that we bear a lot of responsibility for the outcomes we're trying to achieve. And investing is one of the ways that we get to those outcomes we're seeking. But at least on my side of the equation, where everything is marked to market, where you can see price changes instantaneously, it often compels people to react when they shouldn't, or to chase performance, or to abandon things that, for all intents and purposes, are fluctuating for no other reason than there's a lot of emotion, primarily fear, right? And so investing benefits everyone, even the person who isn't the investor, because when resources are diverted away from current consumption and put to use in more productive ways, everybody benefits, right? It raises all ships. And the capital markets, their job is to raise capital, right? It's capital formation. It can be entertaining, it can be exciting, it can be unnerving, but the job of the capital markets is to raise capital. And I think that they're doing their job very, very well. And interest rates are very low, which benefit a lot of things, including real estate, as you mentioned. But it also benefits equities in general. And one of the things that I'm a little bit cautious about right now, and it's a short-term caution, but when there isn't really other opportunities competing for money, money tends to find its way into the things that are performing best. And right now, stocks are performing very, very well by comparison to bonds or cash instruments and so on. And I think it's a time to be discerning, but it's not a time to be speculative. I think it's a time to really continue on with a well thought out plan and invest in a way that is aligned with the goals an individual is trying to achieve rather than performing against some benchmark.
I couldn't agree with you more. And I did want to touch on something that I think is important. It is important to understand, we're very transparent with our business and, where we have been impacted by COVID, right? And the moves that we have made. Because one of the things that has come out of this pandemic is that operationally, we have made a number of different moves that absolutely will benefit our business long term, and we're going to keep those well past this pandemic going away, just because they're the right things to do for our business. But as far as impact, certain markets, there has been downward pressure on rents. West Hollywood has had downward pressure on rents more than a Long Beach, let's say. Units in those markets have also sat vacant longer that we have renovated. But we made the decision to not be impatient because we operate in such a low cap rate environment. If we cut the rents just to get somebody in, we dramatically impact the value of the building in the long term. So I would much rather take a short-term hit to my cash flow and my yield to ride out that hit to the valuation, because that is permanent. And when you think about the cap rate environment that we're in, every $50 of revenue equates to $15,000 of value of back end. So you can see what a huge lever that is. And it's so important when you think about long-term investing, which is absolutely what we do. You've got to think about, is this a good decision in the short term and the long term? And what do those things mean? And we're always going to err to the long term. And so I'd love for you to touch a little bit on tax, because every time you and I end up talking about tax, I feel like I'm getting smarter. So what do you have for us today on that?
But I am supremely interested in the topic, and I spend a lot of time in it every day. So Sage Wealth Planning is a registered investment advisory firm that we are advice-centric, we are planning-centric, and yes, we manage assets, but we are planning-centric. And part of our task for those we serve is to improve tax efficiency, right? Tax is the single greatest impediment to building and preserving wealth. And for that reason, I just don't believe that investment planning, retirement planning, and tax planning can be separated. That's really where the efficiencies lie. We spend a significant amount of time in tax planning because it's necessary to improve and achieve the outcomes on the investment side. The tax laws essentially incentivize and reward certain behaviors. So if you know how to put the rules and the structures to work for you instead of against you, it can have a material impact on the outcomes you achieve. I think one of the things that's most interesting, Aaron, in both of our businesses is this concept of binary thinking. Right? We wind up in conversations all the time where someone has turned a decision into an either or proposition when it really should be better thought of as and, right? And so an example that I might give you is, should I contribute pre-tax or Roth, right? Well, we believe in Roth strategies, but it doesn't mean that if you contribute pre-tax, you can't also take advantage of Roth structures.
That's such a great point. It's really why I, love speaking with you, and also, refer people to you anytime I can, because there's tons of people out there that, do wealth planning, right? But they don't understand tax. They're not looking at the whole thing holistically, and they're not thinking about risk. And those three things, to me, absolutely have to all be considered because all investments are not the same.
You know, a word about risk too, because I think the other thing that isn't obvious is that 20 years ago, the number of publicly traded companies was twice what it is today, right? And through merger and acquisition and the tendency for companies that may intend to go public, but to do so later rather than sooner in the trajectory of that company, and the tendency for some companies to never go public or go back to being private after having been public is probably not obvious to people that the private market is infinitely larger than the public one. There are millions of companies in America. There are only 4,000 publicly traded companies in America. And one of the reasons I bring that up is the concept of indexing and following indexes, even in actively managed funds, requires to some extent that we're invested in the same universe of things, right? But being invested in the private markets gives opportunity to find investments that move to a different beat, that have a low or zero correlation with the other things that we own. And once again, it's and, in my opinion. It's not one or the other, it's both. And a lot of the clients that we consult with have been real estate investors or own rental properties for many, many years. Or they own land that they lease out for farming. And we encourage that diversification because it makes for a smoother ride.
No, I completely agree. Well, Matt, this has been awesome. Thank you again for the time. Before we end, how do people get a hold of you? And we'll put everything in the down below as well. But real quick, how do people get a hold of you?
Yeah, you can find us at www.sagewealthplans.com or email me directly at mdoran@sagewealthplans.com.
Awesome. Well, thanks again, Matt. I hope everybody enjoyed this time, and feel free to subscribe. We look forward to seeing the next one. Thank you very much.
Thanks, Aaron.